Joining me now is Jeff Krumpelman, Chief Investment Strategist and Head of Equities at Mariner Health Advisors. Welcome to the show.
Thank you. Yeah, it's great to be here on Monday morning, right?
Yes, so jobs data was released on Friday. 22,000 new jobs were added. What was your takeaway from that report, Jeff?
I really have kind of a measured response to that. And, I think there's probably going to be a market response that sees the headline and goes, whoa, that was very disappointing, lighter than expected. And I think that definitely seals in, for the market at least, the need for a 25 basis point rate cut in September. I think many other folks have probably said the same thing. I don't think that it probably eases the thought that you need 50. But when we look at the 22,000 new jobs number that was posted, I actually think that the labor market's in better shape than folks realize. And as a result of the lighter immigration, the deportation policies, and so on and so forth, where you've gotten less inflow of immigrants, you've gotten more exits of retirees, of native-born workers, that we're just not going to see the growth in labor force and the 200,000 plus jobs that we were seeing month over month. We're just not seeing that kind of influx into the market. And so we're likely to see, 30 to 70,000 new jobs per month, which is actually adequate to keep the unemployment rate at the level that it's at right now at around 4.3%. So I think it's premature to say, oh my gosh, this is, really a sign of weakness. And we've got to cut.
There's a lot of focus on the September meeting, but what moves do you think the Fed is going to make past September?
Yeah, I think it's going to be data dependent. And we've got, two important numbers that come out this week. We've got the PPI on Wednesday and the CPI data, for August that comes out on Thursday. And so the Fed is got to be looking at this and saying, okay, if we get in future months, thinking about the October and December meetings, if the unemployment number begins to kind of push up while, inflation is rather tame and not worrisome, fine. I think that they'll cut additionally. On the other hand, if all of a sudden you see the labor market data holding up fairly well, unemployment not rising, and the inflation data being concerning, then I think they're going to just sit here and they'll wait. And I don't think there's this rush, to cut. So I think, like anything else, we'll just have to see how the data evolves. And I think that's how the Fed looks at it.
All right, and that leads to my next question. Do you think the Fed will continue to be data dependent? And what else could they be looking out for?
Well, it's a mosaic, so you've got the inflation data and the jobs number, the unemployment claims that go along with that, and so on and so forth. But there are a lot of good things that are happening that suggest that financial market conditions are not overly tight at this point, and that a cut is necessary. You've got earnings data which drives financial assets, which is just outstanding right now. Spending data on the part of the consumer, real wage growth, very solid. Retail sales, very solid. Productivity is actually in a period of renaissance right now, where we're getting really strong productivity numbers. And I think the Fed is going to look at that. And you can have lower job growth numbers. If workers are more productive, they're producing more output per hour, and they're seeing a rise in their real wages, they'll continue to spend. And I think the Fed will take all of that into account, as well as the layoff data. And it doesn't look like companies are laying off people. It's just like fewer people are entering the workforce right now. And so I think they do see a balance in supply and demand for labor that's okay. And all those factors, it's a mosaic. You've got to take all those factors into account.
All right. Thank you, Jeff Krumpelman, Chief Investment Strategist and Head of Equities at Mariner Health Advisors.
Thank you.